Welcome to Spring into ETF Investing. On today's special episode, our panel of guest speakers will be discussing investing in an election year and fixed income ETFs and tax.
This is ETF Market Insights, and I'm Erin Allen, VP of Online Distribution with BMO ETFs. Welcome to the channel. For those who are new to our channel, our goal is to provide timely market-related insights and ETF-focused education to Canadian do-it-yourself investors, with the goal to become your trusted partner in investing. We want to bring you access to the same level of high-quality resources that advisors and institutions receive in our industry. Before we begin, a quick reminder that today we are not providing you investment advice or recommendations. Our channel is all about providing education around investing and around ETFs. Today, I'll be passing off my hosting duties to Jessica Moorhouse. Jessica is a personal finance expert and an accredited financial counselor. She's the host of the popular More Money podcast and is currently writing her first book on personal finance and the psychology of money. It'll be hitting the shelves in January of 2025. Thanks for joining us today, Jessica. Take it away.
Welcome to ETF Market Insights. I'm Jessica Moorhouse from the More Money podcast. Today, we're going to look at investing in a U.S. election year, what this has looked like historically, and what we can expect as we near closer to the rematch between Trump and Biden. We will walk through some considerations for your portfolios and get you thinking about the potential upcoming volatility. Joining me in this discussion is Andreas Rincon, head of ETF sales and strategy at TD Securities. Andreas is a market maker in the ETF industry. ETF investors may not realize how much we rely on market makers for ETF trading and liquidity, so thanks, Andreas, for being here today. We also have Chris Heeks with us from BMO ETFs. Chris is a portfolio manager focused on BMO's equity and derivatives suite. Thank you both for being here today.
Thank you for having me.
Great to be here.
Now, on November 5th, the nominees for president in the 2024 election, Joe Biden and Donald Trump, will go toe-to-toe again in hopes of winning a second term in office. The differences in styles and policies between these two contenders imply vastly different impacts on the risks for the economy. Before we get started talking about the topic of the day, investing during an election, Chris, let's start by looking at the odds.
Yeah, great. So yeah, the odds are very close. If you look at the predicted betting odds, it's about 48% for Trump. It's about 51% for Biden. If you look at the most recent polling numbers, it's about 40% each in the polls. Your third in the polls is Robert Kennedy Jr., by the way, at 10%. But a very, very close election. Some of the key issues I think key issues that voters are looking at. Security of the border, the economy, crime, those issues tend to swing in Trump's favor. On the other hand, issues like protecting democracy, human rights, those issues tend to swing in Biden's favor. It's a very close election. As always, those voters in the middle and those swing states always play a big role. The last, in V1 of the matchup between the two in 2020, you had six of the key swing states flip from Trump to Biden. That included, Arizona, Georgia, Pennsylvania, Wisconsin, to name a few. So those will be some of the key battleground states, and we'll see how it develops. But certainly, as we're just under 6 months out, it's a very close and looks to be a hotly contested election.
And to add to that, Chris, I believe the election was won by only 47,000 votes last time. So I'm sure it will be a close one again this year.
Absolutely. Now, Andreas, how could their different views on policies like trade, as an example, impact some of our portfolios from a sector perspective?
Before we get into the sectors, I think it's important to mention that both historically, a Democrat government and a Republican government have been pretty good for the markets, despite the view that the Republicans would be better for the markets historically. But, there are going to be a lot of differences, but I think it's also important to highlight the similarities. They will both be very strong for inflation. So regardless of what they do, there's a lot of policies that are already in place that will impact infrastructure, the chips, for example, so investment in that space. which will continue to drive inflation in both those sectors. Now, in terms of the similarities between the two, if you look at Trump specifically, you can look at, let's say, tariffs and the China policy. You can also look at immigration and deregulation. Those will be very key policies for Trump. All of these are really inflation-heavy policies. So if you look at Trump overall, you're going to see a lot more inflation in his policies. So let's start with tariffs. We already saw this playbook in his presidency. Obviously, that was a driver of inflation in the US. So we suspect that we'll see that again if he brings those tariffs back or increases them more. Then you get immigration. If immigration is cut off or reduced over the last few years, that obviously will impact labor costs in the US, which will drive inflation in the US. And you have deregulation, which means also a lot more spending from these companies because they obviously have more leeway. As a good example, the banks. Mm-hmm. And then you have lower taxes, which is obviously going to happen very likely with the Republicans, which will likely lead to more spending. All in all, this leads to a lot more spending and a lot more inflation. So what you generally would get with the Trump candidacy or Trump win is a strong market at the start, but then perhaps as that inflation ramps up, you're going to see some suffering of the economy and then the markets. Mm-hmm. But for Biden, you see already the status quo. We already are having a Biden presidency today, and we're likely going to get a lot more of that, maybe higher taxes. But I think what's key is very likely less inflation with Biden, which means that it's perhaps better for the manufacturing space with a Biden win.
Mm-hmm. Chris, anything to add?
Yeah, no, I agree. I think both candidates are kind of pro-inflation, which is obviously going to present a problem when this is the number one thing we're trying to tame from a central bank perspective. I think one thing that comes to mind is, if you look at Trump in 2016, were Trump to win, this is a very different setup in 2024 than 2016. In 2016, there was a lot more fiscal flexibility. He had that ability to drop down corporate tax rates. The balance sheet wasn't as big. If you look at how much debt has grown, it's grown significantly in the US since then. And I don't think he's got that same level of flexibility. He seems to still have that same wish to cut and extend tax breaks. So I do think it's quite inflationary. From a sector point of view, I think Trump versus Biden, I think that tilt towards cyclicals, perhaps under Trump, is a little more strong. That old world economy, so financials, US banking, industrials, materials, some of the sectors, energy as well, traditional energy, that I think under Trump could see a benefit versus Biden.
Mm-hmm. Now, Chris, historically, who has been better for the markets in general?
It's pretty mixed data. So, Republicans probably have a little bit of an edge versus Democrats. If you look at the S&P 500, it's kind of interesting. If you look at the GDP, Democrats actually have an edge, looking at about 100 years of data. But it's very close. I think one of the notable things you can take from the data is divided governments. So when you have, the House or Senate differing from the president's, and that's where you do see a little bit of a drop down in terms of returns. Market participants don't generally like uncertainty. Uncertainty creates risk with respect to the trajectory of what's going to happen, on the ground with the economy. So we do see that little bit of a drop down. Now, if you kind of step back, you got two more very close races right now for the Congress, the House and for the Senate. They're skewed a tiny bit Republican, and we just mentioned that the presidency is skewed a tiny bit Democrat. So it just kind of adds to the uncertainty. I think investors like to see a clear mandate, and so it remains to be seen if that's what the outcome's going to be or not.
Mm-hmm. Now, Andreas, let's look at overall market volatility. And can you review some of the bigger risks or issues we're facing outside of the election?
Yeah, and on that note on volatility, right now the VIX is around 13, which is relatively low if you look at that historically. Generally speaking, the VIX tends to hover around 20 during an election year. So right now we have fairly low volatility and a fairly strong market right now. So you can expect perhaps some more volatility over the next few months as we get closer and closer to that election. Now, really, apart from the election specifically, areas that should be a focus and the investors are really closely watching this is geopolitics is one, for example. We have the conflict in Ukraine. We have the conflict in Gaza, in Israel, between Gaza and Israel. And those are obviously quite key to a lot of investors. They haven't impacted the markets as much, but if it escalates, it will. But the key driver, and Chris mentioned it earlier, is inflation. At the end of the day, we had it just a couple months ago. We had a bit of a scare with inflation rising and the markets didn't like it. So if we see inflation rise again, then we'll always see, obviously the market won't like it again. And what will likely happen is that the cuts will likely be delayed. The rate cuts will be delayed or won't happen this year. And that will not be necessarily positive for the market. So that's, in a nutshell, the real driver of the markets these days. And one of the things that's really interesting about this market, as I just mentioned, is that volatility is relatively low. And it's very likely that it might increase over the next few weeks. And something that's interesting in those scenarios is something to capture the volatility. You want to be able to capture vol when volatility is high. So cover call strategies make a lot of sense in those scenarios because they're one of the few strategies that are selling volatility. They're actually capturing some of the volatility. So we do expect those strategies to pick up over the next few months too.
Mm-hmm. And Andreas, you mentioned rates. Let's look at that a bit more. What do we anticipate this year?
So at TD, the expectations are that we're going to have about 2 cuts in the US starting in September and then in December. And then in Canada, we're going to be a little bit earlier because inflation is a little bit more tamed here in Canada. So we're going to start around July is the expectation with 3 cuts. But it's, at the end of the day, it's a fluid situation. I think the entire street already expects cuts this year, but it really is about, how many cuts do we get and when do we get those cuts? And that's where there's a lot of conversation these days, and it's moving a lot. But we do expect cuts this year as inflation goes lower and lower in the US and Canada. What's interesting because of that is that many investors continue to stay along the short end of the curve and short-term bonds, for example, and perhaps might move to add some duration, longer bonds as inflation actually starts coming down and rates start moving lower.
And Chris, all that being said, what are some things investors should be thinking about when it comes to their own portfolio positioning?
Well, I think you want to stick with the basics and thinking about diversification, staying invested. We're talking a lot about risks, but, I think as investors, we, figure out how to manage those risks. Diversification is the free lunch in investing, in my opinion, and you want to stay invested. So just looking at the asset classes, fixed income, as we were mentioning, going from 6 expected rate cuts at the beginning of the year, now we're at 2. That's come a long way, and we'll see if we even get that 2. So higher for longer interest rates really plays into short-term fixed income products, and that could be our ZST, ultra short bond, or it could be ZMMK, the money market ETFs. And not enough time to go into HISAs, but we're seeing more of that HISA ETF money come into our money market with a higher yield out there. And there's other short-term products like 1 to 5 year in duration. A very popular one is ZCS. So it's a short-term investment grade bond, Canadian exposure. So that's fixed income. And then on the equity side, that the house call at BMO is really to have that US overweight. US has had the stronger economy for many, many years and continues to have that. And the innovation that's happening in the US is certainly a leading component of that. I think investors can look at different factors to take a slightly different approach on the market. And, ones that come to mind that are working very well, quality. So ZUQ is our quality ETF. It looks for companies with superior profitability versus their peers, low levels of debt, and also consistent earnings. And I think as you navigate potentially choppy waters, those are the kinds of companies you want to be invested in. Companies who can maintain that profitability, who can shelter themselves from inflation. And also if rates are higher for longer, not having the debt also plays well. So quality is one. And, there's a couple other factors like a low vol or a dividend where you could take a little bit less risk than the market. So you can stay invested, but be a little more defensive. So that's a couple ideas there on the equity side. And then thinking beyond the 60-40 portfolio, think about an alternatives portion in your portfolio. And there's several, interesting tools you could put in there. We're going to talk a little bit more about gold, but gold as a commodity can have a lot of benefits. So I'll save that. But we've launched long-short ETFs. Long-short ETFs have the ability to profit from declining equities, right? If you're short in equity and equity goes down, you can make money. So that's a good way to hedge market risk and buffers as well. We've recently launched. I think we're going to talk more about that as well. So think about an all-around portfolio, balance it out. I don't think you ever want to have all your eggs in one basket from a portfolio point of view. Take advantage of the ETF suite out there, and BMO's got a very broad suite, across products that could really help you balance and create that targeted portfolio.
Absolutely. Now, Andres, Chris mentioned money market and cash alternatives. Are investors generally more cautious in an election year?
For sure. There's a lot of uncertainty during elections. And Chris mentioned this earlier. Obviously, people don't know really what's going to happen, who's going to win, what they stand for. So generally what happens is they're going to, the buyers are going to then sell, the sellers are going to buy, and then it's going to go back and forth, which creates a lot more volatility. As I mentioned earlier, the VIX tends to be quite high during times, during election years. So you can see a lot more volatility during those periods of time. That then naturally leads into a lot of investors putting more money into money market funds or cash alternatives or very safe, low volatility products in general, and a little bit less money into the S&P 500 or broad markets in general. And we actually have seen that historically, where the flows shift dramatically during an election year. What's really interesting though, right, is that we already saw this last year. So we're perhaps getting ahead of the market in our normal expectations, because last year was the year of, call it, fixed income. It was the year where a lot of money went into money market products, not as much into equity products. And this year, we've already flipped. We've done a 180, where a lot of money is now going into the S&P 500 and the broad market in general, and a lot less money into cash alternatives, as Chris was mentioning. A lot more money in play this year, a lot more beta in play. And BMO has a great product. I think one of the largest ETFs, if not the largest in Canada, with ZSP and ZSP.U, that obviously give exposure to the S&P 500, for example. So this is where we're seeing a big shift in investors. We're also seeing it in the asset allocation ETFs. So mom and pop they're buying a lot more asset allocation ETFs this year. And what's interesting is a lot of the focus for mom and pop has been not in the balanced portfolio or their conservative portfolio, it's been in the growth and the equity portfolio. So if you look at year to date, most of the flows going into asset allocation ETFs have been in the equity portfolio. That just tells you the market is getting a little bit ahead of itself and thinking about next year in terms of market performance. And it's obviously putting a lot of money into work already and into risk, and not into the safer part, which is generally what happens during an election year.
Mm-hmm. And Chris, gold is another area of the market where we can see some opportunity for those looking to steady the ride, so to speak, a potential safe haven. Walk us through how gold bullion can be a hedge in a portfolio.
Yes, we've heard the term real assets. Gold is a very real asset. We've heard of Bitcoin too. That's kind of an unreal asset in a way. Gold is that store of value that's somewhat like Bitcoin in a sense, but has been around for thousands of years as opposed to Bitcoin. But gold, like I said, complementing a 60-40 portfolio with a little bit of gold can have several benefits. And the reason you get a benefit is because you have reduced correlation from gold. So when equities get volatile, or even when fixed income gets volatile, gold often, has a better return experience. If you go back to 2008, the year of the financial crisis, obviously broad markets were down significantly. Gold was up 29%. Gold was up 22% in 2020 during COVID. It outpaced equity indexes. 2022, where you had equities and bonds both down more than 10%. You had gold up 7%. So it's that ability to kind of zig when the market zags that adds a benefit to portfolios. And if you look at gold, it's a store of value against expanding balance sheets, both fiscal and monetary. And we know those balance sheets are expanding, so gold is a store of value. And it also gives you that inflation hedge for that same reason. So, it doesn't take a lot of gold in a portfolio. Like a 5% allocation can add a lot of benefits to a traditional 60-40. It'll tend to improve the return over time. It'll tend to reduce the risk as well, and that's the power of diversification. And if you get more return, less risk, you're doing well as an investor. So I think having a small portion of that in a portfolio can really make a lot of sense from a long-term point of view, and especially if, like you said, as a safe haven asset, if we do see that market volatility, that tends to be the market where gold shines.
And it just happens that BMO has one of the few gold ETFs that are listed here in Canada. There's some in the US and some in Canada, obviously, and BMO's ETFs is fairly well tracked.
Now, Andreas, historically, markets have been strong during election years, as we showed earlier in this session, no matter who wins, with average returns over 10%, which is incredible. If we look at the S&P 500, where we are currently, performance has been very strong year to date. What could investors consider if they think markets are looking a little frothy?
Yeah, we're around 9%, 9.5% year to date, which, as you mentioned, is almost in line with what we've seen historically during an election year. So once again, we seem to be getting ahead of ourselves compared to historical years for election years. So perhaps we're getting already, as you mentioned, a little toppy, where we're nearing some of that high range of historical performance during election years. In those scenarios where investors feel that we're getting into that range, there's a variety of strategies they can look at to protect themselves and, still have some upside. One of them is that we mentioned earlier was cover calls. With cover calls, you're actually earning some premium and giving up some of the upside in exchange for yield. So perhaps you want more yield right now instead of growth because you think at the time or the market right now is a little bit more toppy. You can also look at high quality or low vol, which Chris also mentioned earlier, which are portfolios that tend to be a little bit more protective, more defensive in general. So those are strategies that work relatively well when you think that the market's rallying quite a bit and you want to protect your downside a little bit. What I think is really interesting right now too is buffers. BMO is the second issuer here in Canada that launched buffer ETFs. They're very popular in the US. They've had a lot of inflows in the US. And basically what they give you is some upside, but also limit their downside. And what's interesting is many of these buffers, the buffer in itself or the protection that they give you is about 15% that they launch, let's say. That's close to where we are right now in gains throughout the year. So if you are looking to protect those gains, let's say you're up 10% or something on those lines, buffers offer great alternatives where they can provide protection for that gain that we've had year to date, and at the same time still give you some upside. So it gives you a little bit of both worlds. Well, they say, okay, well, if you think the market's going to rally still a little bit more throughout the year, you have some upside. But if you want to protect your downside today, these are great products to do so. So buffers are very interesting in this specific scenario because we seem to be a little bit top in early in our performance for traditional election years.
Absolutely. Andreas and Chris, thank you so much for this conversation today. I think it's really clear this rematch will be one to watch in terms of its impact on the market. And you both have given us so much to think about in terms of how we might position our investment portfolios given this election year and the other risk factors we're watching this year. Lots to think about. Thanks so much to ETF Market Insights for hosting this great discussion. It's been a pleasure to be here today. Once again, my name is Jessica Morehouse of the More Money Podcast.
And now I'm going to turn over my hosting duties to Cornell Schreiber. Cornell is the host of the Build Wealth Canada podcast and is well known for becoming one of Canada's youngest retirees at the age of 32. He runs a top personal finance and investing podcast created specifically for Canadians. We're excited to have him host today's session. Cornell, over to you.
Welcome to ETF Market Insights. I'm Cornell Schreiber from the Build Wealth Canada podcast. Joining me in this discussion is John Waters, Vice President, Director of Tax Consulting Services at BMO Private Wealth. John is a seasoned tax specialist, leading high-level planning discussions, presenting tax seminars, and writing on emerging developments in his field. We also have Matthew Montemuro with us from BMO ETFs. Matt is the head of fixed income and equity index ETFs at BMO Global Asset Management. He is a CFA charter holder with over a decade of investment experience. Matt, before we get into the topic today, can you give us a bit of an update on how things are with the current interest rate environment as well as the fixed income market?
Yeah, absolutely. So 2024 has had quite the start. Let's rewind to the end of 2023. There was optimism in the market. Both in Canada and the US, expectations were that we were going to get rate cuts. They were going to be early, and we were going to get them often. Well, it quickly, 2024 turned, and those expectations started to get dismissed, and they really started to get pushed out later and later into the year. So here we sit. The Bank of Canada is now poised to likely be the first to cut. So we're expecting the first cut in Canada to be in June or July, with the market expecting about 2 or 3 cuts for the year. But this is where the expectations start to diverge. We're starting to see Canadian and US policy kind of diverge right here, where the Fed now is pushing rate cuts later, really starting to sit on that higher for longer narrative as inflation has continued to be stickier in the US than we've seen in Canada. So right now, if you're looking right now, the expectations of rate cuts in the US, it's only 1 cut for the year, and it's going to be November or December. So the big question on a lot of people's minds is, with the election coming up, how will that affect Fed policy decision making, and will they be forced to wait until after the election to start cutting? And that's what we're all keeping an eye on right now.
John, we've had a lot of fixed income inflows, a lot of it due to the high interest rates that we've been seeing. Now, what I really want to talk to you about, though, is how fixed income is taxed. Obviously, there's different ways that it can be taxed. Can you speak to some of those different methods? What kind of taxation can fixed income investors expect?
Yeah, so typically it would be primarily interest income. So I think of a GIC or a government or corporate bond with a stated coupon rate. When you receive that interest, of course, it's fully taxable, included in as regular income on your tax return. But you also might see a capital gain or loss. And sort of coming back to the corporate government bond scenario, stated coupon rate, it would be trading at either a premium or a discount, depending on what the coupon rate is relative to the market rate of interest. And if you hold that to maturity, you would have a capital gain or loss, depending if it was sold at a premium or discount, or if you sold it before maturity, in addition to the interest income that you're picking up, you'd also have a capital gain or loss. So those are sort of the 2 main components that you would see from a tax perspective.
Can you speak to the tax treatment differences between a traditional bond versus a bond ETF?
Very similar from the big picture perspective. To break that down a little bit more, if, say, the prevailing market interest rate right now is 6% and your bond has a coupon rate of 5%, it's going to be trading at a discount because you could get more out in the market. So when you hold that over the term to maturity, and you'll receive the interest on a regular basis, of course, picking that up fully as interest income, and you hold to maturity, in that scenario, you're going to have a capital gain. So the difference between what you paid at the discount to what it matures at the face value, the par value, is a capital gain. Converse, flip that around. If the bond that you're purchasing, again, has that 5% stated coupon rate and the prevailing interest rate is only 4%, you're buying that at a premium because it's paying more than what you get in the market right now. Hold that to maturity, you'll continue to receive your interest payments. And at maturity, you would actually get a capital loss because you've paid more. You've paid a premium more than the par value. So that difference is a capital loss at maturity. Putting that into more of a macro perspective, when we're thinking about a mutual fund or an ETF, basically it's pooling all these individual investors into the same fund and purchasing an entire, like a huge bond portfolio. So you're gonna have a bunch of these different types of bonds and interest-bearing investments. And at the end of the day, that trust, that mutual fund, that ETF is just a conduit. So any of that income that it's earning is flowed out to the individual investors receiving their proportionate share. So generally that's going to be the interest, the capital gains, and in some situations, maybe a return of your own capital that you've invested.
John, I hear that fixed income can actually be tax efficient at times as well. Can you explain why that is? And for those investors that are fixed income investors that are looking to take advantage of this tax efficiency. How can they go about doing that? What should they be looking for?
Yeah, so right now that opportunity exists with discount bonds because of the way that they are taxed in the different components. So again, coming back to a scenario where you've got two different choices, two different bonds with the same yield to maturity. One is trading at a discount because the interest rate, the coupon rate is low compared to the prevailing market interest rates. So you would buy that and pay less than the par value, receive those lower amount of interest payments at each coupon payment. And then the difference, as I mentioned, when you, at maturity, that difference is a capital gain. Contrast that to another type of bond that is trading at a premium because the coupon interest rate is higher than the prevailing market interest rate. So you continue to hold that, receive those higher amounts of interest income, and then at maturity, you actually have a capital loss because you've paid more than the par value. So that difference, capital loss, could be offset against capital gains that you might have in other securities. So in that scenario, it's actually more tax inefficient because you're receiving a higher amount of interest income and then the capital loss. Whereas in the discount bond scenario, you're receiving lower amounts of interest and a capital gain. And recall that capital gains under the current tax legislation are only included at 50% as opposed to 100% on interest income. So even though you might be receiving the same amount of income in both scenarios, the discount bond is going to be more tax efficient because of that capital gains component and the lower interest component. So the net after-tax amount in your pocket is going to be more. And for a taxable investor, someone investing in a non-registered account, that's what's critical.
Matt, with rates expected to come down, what will this mean for the fixed income market in general, as well as the tax efficiency of discount bonds?
Generally, in an environment where rates are coming down, it is a positive for fixed income. So longer duration, longer term bonds tend to outperform because they have a higher degree of sensitivity to interest rate changes. So, yields come down, prices go up. So you tend to see outperformance of fixed income in periods where rates are coming down. In a vacuum, if rates are coming down, that means yields are coming down. And if coupons are relatively stable, that will make the overall fixed income universe less tax efficient. Because like John said, that differential between coupon and yield to maturity, that's really where that capital gains portion is that makes the fixed income environment more tax efficient currently. So yes, in a vacuum, you are going to have fewer discount bonds available because prices are going to go up and there's going to be bond prices that go above par. But that also, I think as investors, we have to remember in 2020 and 2021, we saw record issuance at record low interest rates. So there's still going to be options for bonds that were issued 5, 7, 10 years ago for us to pick and choose, bonds that have coupons between generally 1% and 3% that would still exhibit characteristics in that same tax efficiency. So overall, from a universe perspective, yes, the overall fixed income universe will be less tax efficient as a whole, but there still will be opportunities for investors to pick and choose between very specific discount bonds and still take advantage of the tax efficiency inherent in the fixed income market.
Matt, let's talk portfolio construction strategy for a minute. Since the rates are on pause, would it be better to go for shorter duration when it comes to our fixed income, or should we be considering going for longer duration?
Yeah, so I think the trend we've seen in the last 18 months has been everybody sitting on the sidelines, staying in cash, money market, really optimizing, taking advantage of that inverted yield curve, getting paid 5% to basically wait out the volatility in the market. But as we look forward, we do expect rate cuts to come. So right now in Canada, we're seeing June or July as the first cut, and we do expect to see kind of 2 to 3 cuts for the remainder of 2024. So, on the one hand, I do see investors, at an absolute level, you're still going to be getting a yield of 475, 450, 425. And if you look historically, that's still quite attractive. So I think we're still going to see investors sit on the sidelines, take advantage of that short end, those higher yields. But I do think for investors who are looking longer term, who are looking at returns over the next year, now would be the time to start considering adding duration to your portfolio. Duration, again, when yields come down, bond prices go up, and that's when duration is your friend. That's what's going to give you some upside in the fixed income portfolio. So I wouldn't recommend investors necessarily going all in on the long end, going to buy, the 2053 bonds in the market. What I would say is looking at a more aggregate solutions like ZAG, our BMO Aggregate Bond Fund, or ZDB, our BMO Discount Bond Fund. That provides you with full term exposure. So short all the way to the long. You're getting a duration of about 7 years. So you're going to have some of that upside in terms of when rates come down, you're going to have that sensitivity to interest rates. But if we see cuts slower than the market expects, you're going to have that exposure on the short end that's going to provide you that downside protection. So that's where I would say investors should start to consider adding duration to portfolios, but I would do it in a more aggregate manner in ZAG or ZDB rather than going necessarily all in on the long end.
And Matt, we've seen a lot of inflows into the high interest savings accounts ETFs, also known as HISA ETFs. It seems that a lot of GIC investors, they like having that security for their cash. And that seems to be very appealing for them. What kind of solutions does BMO offer when it comes to this area?
Yeah, BMO, we have a very comprehensive suite of cash alternative products. So, both whether it's Canadian dollars or US, we have products that offer across the spectrum of risk and yield. So on the lowest risk side, we have something called ZMMK, which is our money market ETF. That provides investors with the most security, but also provides them with an yield enhancement relative to a HISA if you're looking at kind of an apples to apples comparison. So for investors who don't want to take any risk on that cash allocation, but still want a yield enhancement, ZMMK would be an excellent solution for them. For investors who are willing to take a little bit more credit risk, but want to maximize the yield out of that cash component while they can, because, if everyone's saying rates are coming down, they may want to maximize that yield right now while they can. So something like ZST, our BMO Ultra Short-Term Bond Fund, it invests in high quality corporate bonds that are 0 to 1 year to maturity, and we hold those bonds kind of from 1 year all the way to maturity. That would provide you with a little bit more credit risk because you are investing in corporate bonds, but you're also getting a yield enhancement relative to both money market and HISA. And as we've talked about that tax efficiency, because we're investing in, again, corporate bonds here, ZST will have a significant after-tax advantage for those taxable investors who want to maximize their yield.
From a tax perspective, what are the key differences between something like a high interest savings account, ETF or GIC versus ZST, for example, from BMO?
Yeah, so from a HISA or a GIC or a money market fund, that's going to be anything you earn, that top level yield that you see, let's call it 5% today, that's going to be 100% interest income. So when you look at your returns for a taxable investor, your expectation should be that is going to be taxed as income. For ZST, you're seeing a little bit of a difference in characteristics here. You're getting a coupon of about 2.75 and a yield of about 5.5. So 50% of that return will be income and 50% of that return will be capital gains. So when you're looking at comparing them for a taxable investor, there's significant after-tax benefits of owning the bonds in ZST versus the alternatives like a GIC or a HISA.
John, can you speak to the increase in the capital gains inclusion rate that we saw after the federal budget? Does that change your analysis and your recommendations at all?
No. So there were some proposals in the recent federal budget about a month ago to increase the capital gains inclusion rate from 1/2 to 2/3 after June 24th. So does change the number slightly because, of course, we're talking about the difference between taxation of interest income at 100% and capital gains today at 50% and potentially at 2/3 in about a month's time. So, however, the capital gains, of course, even at a 66% inclusion rate, will be better off than interest, which is obviously fully includable in income. So, slight loss of tax efficiency there. But I would point out that that these are only proposals, and that there is the first $250,000 for an individual investor is proposed to remain at the 50% inclusion rate and not go up. So even if it is at 2/3, it still makes sense because of the capital gains is still taxed less than interest. But for most investors below that $250,000 threshold for individuals, they're probably not going to be affected by these changes.
Matt, as we are in a US election year, are you seeing any sort of trends when it comes to investing, particularly on the fixed income side of things?
Yeah, so I think that's the top of mind for every fixed income investor right now. When we're looking at trying to predict what the Fed is going to do, the big question is, if the Fed doesn't come this summer, and right now it's not expected to, will they be willing and able to cut rates prior to the election? There is historically, the Fed has tried to sit out, election periods. They don't want to add fuel to either candidate, add any sort of policy. They don't want to be part of the conversation on the run up to the election. So a lot of market participants think if they don't come this summer, that they'll wait until after the election to start to cut rates. So now we're already looking at November or December for the first rate cut in the US. So that's something that a lot of investors are pondering with. Will they be willing to come in the fall if they think that's the right time, or will they just wait it out until the election comes? If you look historically of what happens in markets during election years, volatility increases, which makes sense. If you have uncertainty on policy, if you have uncertainty what candidate's going to come into play in the political system, that just brings uncertainty and volatility to markets. So traditionally, what investors have done is they've taken their money out of the equity markets, they've out of the bond market and moved it into money markets. So, basically risk off trade, moving on the sidelines and allowing that volatility and outcomes to kind of come to fruition. So we expect that trend to continue. We've seen 2 years of flows of short-term rates and into the short term. And if the Fed's not going to come and cut rates, and we're going to have increased volatility in equity markets because of the election, it makes a lot of sense for investors to either stay or continue to migrate into the short end. So we do expect short-term fixed income to see increased flows throughout the second half of 2024.
Great. Well, gentlemen, thank you so much for coming and for sharing your insights with us. It's clear that navigating the fixed income market can present its own challenges and opportunities. So thank you for sharing some of your thoughts around how investors can consider the taxation of fixed income ETFs and how there may be some attractive opportunities on the horizon for investors. Thank you so much to ETF Market Insights for hosting this great discussion. It's been a pleasure to be here today.